Okay, so let's go ahead and let's start to look at some of the material about that I want to talk about today. Now, if you look at the syllabus for today, I indicate that we're going to look at localizing the valuation equation. I decided to move directly to financial engineering instead. And because I think it gives a better tie-in to what we were talking about last time as we were looking at equity values and as we were looking at calculating goodwill. We'll come back and deal with LBOs and deal with a localizing the valuation equation here perhaps on Wednesday before we enter into our review for our next exam next week. So when we think about financial engineering, what we're talking about are a class of decisions that are made in the firm that are expected to hopefully benefit the firm's stakeholders. And those would be off-balance sheet transactions, maybe transfers between related entities, and holding cash and debt simultaneously. Those are the three areas that tend to be the most sensitive to what I'm going to refer to as financial engineering. And again, financial engineering is something that we as financiers would do inside of the company to try to improve the stakeholder condition. We might have to add to that anything else we could do within our financing structure that would also benefit stakeholders, not just limit it to these first three bullet points. But let's talk about these first three bullet points for a second. What is an off-balance sheet transaction? Some of you will remember the name Enron, a financial and market disaster from the late 1990s. Excuse me. And Enron was a company that had to do with energy and energy distribution, not so much exploration, but oil and gas and electricity distribution. And Enron had this extraordinary financial run. They had some really bright people. They seemed to be making some extraordinary decisions. They were making bank. And then the Enron world fell apart. And it fell apart because of what were referred to as off-balance sheet transactions. So let's think about this for just a moment. Let's assume for a minute that our company, which is subject to mark-to-market accounting, okay? Our company has a subsidiary. And that subsidiary, let's say, owns some real estate and spins off some operating income, but we don't own it in its entirety. We have a minority interest in it, which means we own less than 50%. And if we own less than 50%, we must go through a mark-to-market accounting process each year when we talk about this on our balance sheet. Who remembers what mark-to-market is?
Essentially, it's just increasing the value of an asset to reflect the fact that its market value has increased.
Or more finely put, changing the value of the asset on the balance sheet to reflect changes in its market value, okay? So when its value increases, then we can expand the balance sheet. We have to have a corresponding entry on the income statement, so that would be an increase in EBIT on the income statement, and that would then lead to a higher value for the company, right? Sure, anytime EBIT increases. So that's nice. And so companies, when they see their assets on the balance sheet rising in value, they're happy to mark them to the market because it increases their EBIT as a non-operating income, or it increases their revenue for a non-operating income, and that leads to a higher valuation for them. But when we have just the opposite taking place, when values go down, we don't want to mark them down on the balance sheet because that's going to reduce the value of our company. So oftentimes, we'll move that asset off the balance sheet. And what that means is we'll move it into another corporate entity or another business entity, maybe that has a different ownership even. And rather than show the asset on the balance sheet, we'll only show the revenue that comes from the asset as it enters our operating revenues. Well, in doing that, we haven't necessarily increased the stakeholders' value, but we've helped it keep from decreasing. Okay? And so that's an example of an off-balance sheet transaction. We take it from our company's balance sheet to another. So think back to this case we were looking at just a moment ago. We had these two items. They were patents held and rental property. I think they had a balance sheet value of 185. If we believed that they had a real market value that was greater than that, then we perhaps would have gone ahead and marked them to market on the upside, and it would have given us additional revenue that we would have had to post on the income statement, because that's how we recognize that. You can't only change it on the balance sheet, you've got to change it on the income statement as well. And that would have expanded the value for the stakeholders. But if we think they're going to go down, then we want to get that asset off of our balance sheet so we don't have to continue to suffer with it going down, right? And so this financial engineering doesn't necessarily increase value for the stakeholders, but it keeps it from going down. And so there would be a form of financial engineering. When I say transfer between related entities, any idea what kind of financial engineering or financial smoke and mirrors might happen there? So I know that Fred and some of Fred's family, this is when the company was much smaller, but it was publicly held. Fred and Fred's family owned a couple of other business entities. And more than once, Fred and his senior managers decided to go ahead and sell some products that they had manufactured to one of these related entities. So they sold it to the related entity. They sold it to that entity using some financing, that inter-party financing, and then they waited a period of weeks, and then the entity sold it back. When they sold it to the entity, they booked it. They were able to book the sale. When they bought it back at a lesser price. So not only were they able to recognize sales in a quarter in which they didn't actually have sales, but they were then able to show some input costs when they bought it back and then sold it later on to a real customer. They showed an input cost that had reduced, and they got to sell it again. So it increased revenue. In fact, it showed up twice on the income statement. And so it expanded their revenue, and it reduced their input costs. And they then were able to show an improved EBIT, not only for each of those quarters, but the year, and that expanded their shareholder value. That is an egregious example that, frankly, was just a hair's breadth shy of felonious. Well, the only reason they ended up not facing some serious problems because a very smart CFO went ahead and footnoted this on the audited financial statements that they used for their quarterly regulatory reporting. But it was buried so deeply that you had to have a magnifying glass and be super curious to find it. But that's a transfer between related entities. There is no real sale there, right? There is no real activity that created anything real. Just like an off-balance sheet transaction, there's no real activity. It's engineering. It's alchemy. Think about holding cash and debt simultaneously. You guys know Apple, and I'm not going to be right with my numbers here. I'm going to be in the ballpark. But you guys know Apple has about $260 billion of cash on its balance sheet, right? And activist investors like Carl Icahn want Apple to repay or to go ahead and spend some of that cash off to the shareholders instead of keeping it on the balance sheet. And they want it in dividends or repurchase obligations. And they're resistant to doing that. We also know that Apple very actively borrows money in the debt markets and has a substantial amount of debt on the balance sheet. Last I knew it was like $60 billion. Well, why would you have $60 billion in long-term debt when you have $260 billion in cash sitting around? What would be the purpose?
Are there like any tax credits because of it or something?
Well, Will, there are tax ramifications. I don't know about tax credits, but in this case, their cash on the balance sheet isn't just in the U.S., right? It's cash that's built up from profits in their various foreign subsidiaries as well as the U.S. So only some of that cash is really domiciled in the U.S. and the rest of the cash to bring it back to the U.S., which is where they do most of their investing. To bring it back to the U.S., they would have to repatriate it, and in so doing, pay taxes on it. And the tax rate that they would pay is meaningfully greater than the small amount of interest they pay by borrowing money. So if you're the head of the company in Washington, and you say, hey, here's a $10 billion opportunity that we want to take for an investment, we can either repatriate some of our cash from our French operation at 26% tax, or we can go to the bond markets and we can borrow money at less than 2%, because Apple can borrow money at extraordinarily attractive rates. Well, what are you going to do? You're going to borrow the money, right? You're going to pay 2%, even if you had to do it for 10 years. That's still less than 26% hit right now. So when you think about this, all of this is designed to create additional value for shareholders. And it's simply an effort of, or an effect of, financial engineering, okay? But there's one more. Can a firm increase the value to its stakeholders without increasing operating income? Well, we know it can do so with off-balance sheet transactions, transfers, and cash management,